Welcome to the CBS Eye on Money show. It is Thursday, March 10th. And I know that the recent trials and tribulations of the world can really get to you. I also know that in these moments where markets are moving around so dramatically, that it is kind of scary. And I think a lot of people are starting to worry that maybe this thing called investing is a little bit too much of a ride for them. I don't want you to get spooked by this. I just don't want you to. So what I want to do is I want to play a segment that I did on CBS Mornings, which I fondly call the Investor Boot Camp. And I want to do that because it's a way to kind of remind you why you're investing or help encourage you to begin investing. So Nate Burleson and I did this segment last week, and it was after one of those god-awful days where stocks plummeted. So let's air this segment. Let's put this on, and then Mark and I will come back on the other side of it, and we'll talk about it.
Money on my mind, money on my mind.
Money is on our minds, that's for sure. In today's Money Watch, we're talking about investing, how to start, and how to stay out of trouble as the markets fluctuate. Investing is an important way to save for your future. Last year, about 50% of Americans say that they own stock. Investments can be important to fund things like retirement and college tuition. With tax season underway, millions of Americans are already receiving refunds, and those checks can be a great way to start investing. CBS News business analyst Jill Schlesinger is here to break it all down for us. All right, so let's jump right in. Yesterday, the stocks were tumbling. So why is it important to jump in when things look terrible and uncertain?
You know, when we look at other parts of the economy, when something's on sale by 10 or 15 or 20%, we get psyched. But all of a sudden, when stocks are on sale and stocks are 11 or 20% lower than they were just months ago, we get really nervous. So here's what you need to do. Confront your fear and understand that this is the best way to actually reach your long-term goals. You got to build the foundation. You got to make sure that you've got your emergency reserve fund and pay down your credit card debt. But then investing really becomes a key component in your financial foundation.
And you also say investing is an important way to help fight inflation.
This is so interesting because the whole point of investing is to grow your nest egg faster than the inflation rate. Now, if you look at the last 3 years, if you were an investor, you've made about 115% since the bottom, and that's way in excess of the inflation rate. So this is the power of compounding, of starting early and getting your plan jump-started.
Okay, now speaking of starting, how do you start if you've never invested before?
I think the most important thing is if you have a workplace retirement plan, it's really the easiest way to start. So that's a 401k or a 403b or a 457. They take that money out automatically from your paycheck, so it's really easy. But if you don't, maybe an IRA or a Roth IRA, you can open up an account pretty much anywhere, any bank or app, and you can automatically have money go from your checking or savings into that account.
So speaking of apps, or companies are the ones that you look at and say, okay, these are places that are a good place to start?
I like places where you can invest cheaply in index funds. So that means that we're talking about Vanguard and Fidelity and T. Rowe Price and E-Trade and Charles Schwab. And you know what? There are lots of options out there. Explore them. Many of these places actually don't even require minimums to start. So you literally can start with $5 or $10.
A mentor of mine once said, when learning something new, remember a KISS, K-I-S-S, keep it simple, stupid. You say keep it simple, but not put all of your eggs in one basket.
Right. I mean, keeping it simple means maybe just using those cheap index funds, but you really want diversification. You don't want a big bet on any single area. So a little in the stock index fund, a little in a bond index fund, some cash, maybe some commodities, and then don't futz around with it. Stick to your game plan. All of these companies will allow you to actually take a risk assessment questionnaire and will also allow you to say how long before you need the money. These are the important metrics, not whether you beat the market. When do you need your money? How much risk can you absorb?
Those sitting at home asking, well, how much do I need to start investing? What would you say to that?
I mean, it's really as little as zero because all of these new companies have really basically democratized investing, meaning they have made investing available for everyone. So you get that tax refund. Last year, the average tax refund was about $2,800. You get that tax refund, you pay down your debt, get your money working for you.
What I love about Money Watch is we keep it real and we keep it Jill. Thank you so much.
Okay, Mark. So, when markets are going nuts, it's so weird because, of course, human behavior is crazy. So I'm wondering, how have the emails been lately as markets are gyrating? We getting people worried?
Oh yeah, there's definitely a little sense of panic out there. That's for sure.
Yeah. I mean, and you could imagine that, especially for a newer investor or someone who started maybe after the COVID era began, where markets, yes, they gyrated, but they've mostly been going up, that it's pretty agonizing. So what's your best advice to people who are, maybe they got a little tax refund in their hands and they say, I want to get going. What do you think they should do?
Kind of comes down to your big three, right?
Yep.
I think there's three big things that you have to check the box before you want to really consider jumping into the investing game. And that's have your 6 to 12 months of emergency reserves, be maxing out your retirement account to the best of your ability. And of course, getting rid of the consumer debt, credit cards, car loans, stuff like that.
It's amazing to me how many people actually don't have a retirement plan through work. And I think it's a lot of these small companies. I don't know why. It seems to be the easiest thing in the world, but it's also really easy to open an IRA or a Roth IRA. As many of you know, we are huge proponents of the Roth IRA. Just as a reminder, when you have a traditional IRA or a traditional 401k or 403b, the money that you put into that account is not counted as income for tax purposes. And so what happens is, because it comes out pre-tax, the actual amount of money that you receive for tax purposes is lower. So you get this nice feeling of like, wow, I don't pay as much in taxes today. So the money grows without any taxation until you get to your age 59 and a half. That's when you are allowed to start taking money out. But when that money comes out, it's taxed at whatever your income tax bracket is at the time in the future.
As Ed Slott said, pre-tax basically just means a loan.
A loan. That's right. It's a loan for a bit. Conversely, when you have a Roth retirement account, you don't have any tax deduction today. There's no current taxation on the earnings or the capital gains on anything you do in the account. But when you access and withdraw those funds later, after age 59 and a half, no tax due. Kind of awesome. And Mark, I think that one of the real benefits that people are seeing with their Roth accounts is no required minimum distributions. Those are huge.
Yeah, that's huge. That's probably the biggest perk, in my opinion. I've told you that my goal by the time I hit retirement age, whenever that is to basically have all of my assets in either a brokerage account or a Roth account.
Yeah, I mean, the thing that's interesting that people don't get is, you have all this money that hasn't been taxed. You're forced to take it out. And yeah, you have to pay tax. But not only that, there are these little stealth taxes. That's what Ed Slott likes to call them. There is money that is you never think about until you're in the middle of it that has to go back to the government. So let me give you one of those areas. It's called IRMA. And she ain't your great aunt Irma. IRMA stands for Income Related Monthly Adjustment Amount. What is that? It has to do with Medicare. When you earn a bunch of money, then the government says you have to pay more for Medicare Part B and Part D. How much more? I mean, it's real money, Mark. I mean, if you think about it, let's say you're married filing jointly, okay? If you make, say, more than $200,000, then you're going to start paying more for Medicare. Now, that may seem like, $200,000 is a huge amount of money, but for people who have socked away a ton of money in retirement accounts, and maybe they've got pensions, maybe they've got Social Security, maybe they've got investment income, and now all of a sudden they have required minimum distributions, it's amazing. It does add up. So that's just one place where you can see where you get penalized for not having paid your taxes earlier. The other part of this is that we just don't know where tax rates are going. And Mark, I think that if we were going to be betting men and women, or non-binary if that's you, we would guess that tax rates would probably rise in the future, right?
Yeah, you would think so, but who knows? It's all one big uncertainty. That's why I love the Roth. I love eliminating all that uncertainty.
If you can eliminate uncertainty, there's so many times in life where things are so up in the air and out of your hands. This is one area where you can just understand exactly what your liability is going to be. Meanwhile, also during that segment, you heard me throw out a few names of different companies that you might want to check out. As far as I'm concerned, you can invest anywhere as long as you can get an index fund that's really cheap. And not all index funds are created equal, Mark. I mean, there have been so many times where we talk to people and they're like, oh, I have an S&P 500 fund and it's from like some big ass insurance company. And all of a sudden they're paying like 0.8% for an index fund. Index funds should essentially be free or 0.1% or less. That's it. What else do I have to tell you? Oh, what about one thing I didn't mention, Mark, in the segment was target date funds as a way to get started investing. What's your opinion on that?
I think if you're just starting out and you're not confident in your abilities, then sure, I'm okay using a target date fund to get started. I mean, that's what I did when I first started. I had no idea what I was doing, so I just picked a target date fund. But as I learned more and more and more, I realized that I could probably do this cheaper by selecting some individual index funds.
And also, all target date funds are not created equal, and each fund family has a different way of managing target dates. So there are some that say that, let's say you're retiring in 2055, they might have a different allocation than the different company. So just go in and kind of double check and see, like, does that seem reasonable? And take some risk assessment questionnaires and give us a holler if you need help. We would really be happy to help you out. And if you're just getting started or you need a little investor boot camp, Mark and I are here for you. That's what we do. Just go to our website, jillonmoney.com, click on the Contact Us button, and we would be happy to help you out. Now, while you're on our website, first of all, bookmark it because you're going to want to come back to it. And second of all, make sure that you sign up for our free weekly newsletter. You can follow the Eye on Money Show wherever you find your favorite podcasts. And maybe you want to check out our other broadcast. It's called Jill on Money. See, just easy like that. We drop episodes every Tuesday and Thursday here. And Mark Talercio, you've just heard his voice. He's the co-host and the executive producer. We are distributed by CBS. We ask you to do something nice for someone else today. It will make that person feel better. It will make you feel better. Curiosity, compassion, community. That's our mantra here. Thank you so much for listening, and we'll talk to you next week.